Hey everybody, it's Daniel here from InfoVest. Hope you're all doing well. We got to talk about the commercial real estate market again. It's going to be more important in the coming months for this year and next year because there are risks starting to arise further and further. We talked about this before, and I'm going to also bring up this old article that comes from Bloomberg. This was posted in April of last year, but it's important, and I'm going to go over this article and I'm going to explain why it's relevant for this year and for even next year as well. Now, this Bloomberg article, I'll link it in description so you could read up on it, but it's titled "A 1.5 trillion wall of debt is looming for US commercial properties. Morgan Stanley sees refinancing risk front and center. Office retail property valuations could fall as much as 40%. Almost 1.5 trillion of US commercial real estate debt comes due for repayment before the end of 2025. So we got 1.5 trillion dollars, okay? 1.5 with the T, trillion, coming due by the end of 2025. Starting now, it's already been happening. We have about already last year, I believe, if I have my numbers right, 500 billion that has come due in terms of refinancing, and a total of 1.5 trillion including this year and by the end of 2025 are going to come due. Which means what? Which means that these office buildings, these commercial real estate, these owners of these properties have to refinance at a higher rate because rates are much higher. And the fact that since COVID pandemic time, people are not really going to the office like they were previously. A lot of people are staying at home. That's a problem because they're making less money. If they're making less money and their interest payment is higher and they're losing money, and the property values of their properties are falling significantly, why would they get refinanced? Will they get refinanced? Why would they keep the property? In fact, it would be best for them to just simply default and hand the keys back to the bank, which is very likely to happen in the coming months. Now, in this article, it goes on and says refinancing risks are front and center for owners of properties from office buildings to stores and warehouses, says Morgan Stanley. The maturity wall here is front-loaded, so are the associated risks. The investment bank estimates office and retail property valuations could fall as much as 40% from peak to trough. I'm even hearing 80% drops already in some of these property values. Really bad destruction in terms of the values there. Adding to the headache, small and regional banks, the biggest source of credit to the industry last year. So a lot of the of this 1.5 trillion dollars is owned by small regional banks, and that's why you hear, like, for example, like the stock NYCB dropping, and many of these stocks exposed to the commercial real estate market dropping like a rock because they're exposed. And about 75% of the small regional banks own a majority of this commercial real estate. And yes, also some of the big banks are also exposed to this as well, and that can also be a big risk. Now, rising interest rates and worries about defaults have already hurt CMBS deals. Sales of securities without government backing fell about 80% in the first quarter from year earlier. Less sales happening because the rates are moving higher, and here they're talking about an 80% drop in the first quarter from a year earlier, right? So this CMBS, which stands for Commercial Mortgage Backed Securities, is a big problem, right? It kind of sounds similar to MBS, right? If you remember in 2008, the mortgage-backed securities, right? The crisis that happened in 2008 where real estate was heavily affected, right? We saw a big crash there in the real estate market in 2008 because people were over levered. They were just manipulation happening. Everyone was, the big banks got carried away. The rating agencies as well just became really ugly. and it caused this basically a crash. Now the thing in 2008 is that people knew that the real estate market was a bubble and it was over levered. They knew in 2005, they knew in 2006, 2007, but the crash didn't happen only until the end of 2008 when it really finally tumbled, right? So it took quite some time, and we're seeing similarities here. Everyone's talking about the commercial real estate crash. And that it's going, and how that's going to affect the stock market and the economy, and the recession is going to come and it's going to be ugly, and etc., etc. But it hasn't happened yet. The stock market's been actually going up. Everything looks fine. The job market looks amazing, right? You're getting all this data coming out as if that, nothing's bad. This is soft landing, as they may say, right? So it may take time, and this wall of debt of $1.5 trillion that's coming due is probably not, it's taking its time, and it's probably not going to show its real teeth as we come to that due date, and until a really big black swan event or some big player really falls on their knees and causes ripple effects throughout the economy and so on. So this is a big risk that we could see for 2024, 2025 and onwards. There's more debt in the commercial real estate market in the trillions that is due. There's about 2.2 trillion that's due also by 2028. Fitch also just recently this month also came out and said U.S. apartment, the defaults for U.S. apartment, multi-family, these complex they're expected to see default to double, right? So we're not only talking about office properties here in trouble, but these apartments could see delinquencies rise 2 times, double the amount, right? And that's because, again, problem with payments, problem with the economy, loss of jobs expected to probably see, and the increase. Here's the thing, the increase in supply, because the sales of real estate has come to a complete halt. There's not many deals. It's hard to find really good deals right now in this market, especially because the interest rate is so high. So if that's the case, and all these buildings that's being built by the builder and all the supply, if it comes up into the market, you're going to see that supply inflow, which is going to cause the price to come down. And then if you got to refinance, the bank's not going to value your property the same way, which could, hence why Finch is saying that you could see the default rate go up 2 times, double the amount. Now I want to bring one thing up also. I want to talk about the 2008 subprime mortgage crisis, right? Going back, relating this to the subprime market and what happened there. Okay, so couple of points here, right? It was a very big crash that happened in 2008. It took its time, right? 2005, 2006, 2007, even first half of 2008, nothing really bad until the end of 2008 when the fallout happened. And this had ripple effects for a very long time, okay? What happened during that time was that 3.4, okay, during the great financial crisis, 3.4 billion in real estate wealth was wiped out. Okay, listen to that for 1 second. 3.4 billion in real estate was wiped out during the great financial crisis, the greatest financial crisis. Okay, we're talking today in 2024, by the end of 2025, 1.5 trillion coming due. So if you compare the two, if that 1.5 trillion ends up defaulting, even a part of that, half of that ends up being more than what was wiped out during the great financial crisis, 2008, which was 3.4 billion versus 1.5 trillion now. 3.4 billion in 2008, 1.5 trillion now. Okay, that 3.4 billion in 2008 caused a 7.4 trillion in stock market paper losses. Okay, from a 3.4 billion real estate wealth being wiped out, it caused the stock market to drop basically 7.4 trillion in losses, right? And we had the unemployment rate go up, basically double from 5% to 10% in 2010. So this lasted a long time. Remember I said the data is very lagging, the unemployment rate's very lagging. Guess what? In 2010, right, you had the unemployment rate sitting around 10%. Now, the difference between that time and what we saw during COVID is that during that time, by the end of 2014, the Fed had already pumped more than $4 trillion back into the economy. Okay, so $4 trillion into the economy, the stock market saw losses of 7.4 trillion, didn't really, subside the whole losses there. And in 2020, when you saw the COVID crash, the Fed pumped way more money than what the losses were, which is why we saw a quick V-shaped reversal. Okay, here's the key. If the 1.5 trillion ends up defaulting, I wonder how big of the stock market losses are you going to see if that happens? Will we see that panic crash? Will we see something bigger than 2008? That's my first question. Second question is, if that happens, or if there's a stock market tumble, even if it doesn't crash that hard, let's just say, what will the Fed do? That's the key question there. They pumped $4 trillion into the economy back in, when the great financial crisis happened. In 2020, they did way more than that. The question is going forward is, if this happens, this crash, this crisis, this black swan event, I want to know not about rate cuts. Because rate cuts, okay, fine, you can do rate cuts, but it's not that important. It's not going to change the needle so much. You created damage already. By the time rate cuts come, the damage has happened. The question is, how are you going to restore that damage? And how do you restore that damage? Is through pumping money, liquidity, injecting the economy with some steroids right there. And that steroids is the money, the liquidity. So if, let's just say hypothetically, another 7 trillion was lost in paper losses, does the Fed come out right away and say, boom, 14 trillion, let's put it into the economy right there and then? Pump the markets. That's where you can get this euphoria and markets going back up and so on and so on. But if they don't, that's a big problem, and that could cause lasting effects, because we know, and we've heard from the Fed in its 60 Minutes interview and from the press conference, that they will move once they have evidence that they will move on interest rate cuts once they have evidence that the economy, the inflation has come down to their target, and they're also ready to cut if there is some sort of problem in terms of the job market, because they have a dual mandate. One is inflation, one is the job market, and they know very well if the economy is going to tank and the job market and unemployment rate is going to skyrocket, they will achieve their inflation target. So if that's the case, then they're ready to make a move. The only question is, how late are they going to be? We know their track record and their history. They tend to be quite late. They tend to move late. We see that the market's pricing in rate cuts in March. The Fed came out through cold water, said, no, we're not getting rate cuts in March. And in fact, in the 60 Minutes interview, it mentioned that there might be rate cuts, possibly a rate cut in maybe the mid of the year. That's when you could get the first rate cut. So we'll see what happens. But very interesting numbers here, especially, again, going back to that point. 3.4 billion in real estate wealth wiped out in the great financial crisis, versus we're talking about 1.5 trillion coming due. If you get half of that or less than half of that, it's still a significant amount, which makes you wonder, how will that have the the ripple effects in the economy. How will that affect the job market, the unemployment rate, and so on. So very interesting here. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified of the next video, and I'll see you guys around. Cheers, and bye.